the session 5, the presentation on the 2023-2024 African Sovereign Credits Review Rating Review Report. And I will be joined by Ms. Sonia Esambajo, who will be presenting the 8th edition of the Sovereign Credit Rating Review Report. And joining me on the panel as well, I will have Prof. Daniel Cash, who is a professor of law at Ashton University. If you could please come to the podium. Ms. Hannah Ryder, she is the CEO of Development Reimagined. She will also be on the panel. And I have Prof. Afrikaner Jerome, who is a special advisor to the Commissioner of Agriculture, African Union Commission. Please, if you could join us on the panel. I will now invite Madam Sonia to take the floor to present the 8th edition of the African Sovereign Credit Rating Review Report. Over to you, Madam.
Good morning, distinguished participants. So I will be presenting on behalf of Dr. Mishek this morning. So every semester, ECN, the African Peer Review Mechanism, publish a report on the Sovereign Credit Rating Review for African countries. So my presentation will cover the second semester of 2023 and all the rating actions and the drivers for those rating actions. So as you can see here, there have been, and this has been a trend during 2023, more downgrades or negative outlooks than actually upgrades or even positive changes in credit rating outlooks. So you can notice that for the second semester of 2023, just one country was actually upgraded, Republic of Congo. However, you see that in terms of either downgrades or negative outlooks, there have been more than nearly 20 rating actions. And we will also examine what were the drivers for such, rating actions in Africa. One key driver was, the challenges around cash management and liquidity pressures. The second one was the persistent, shortage of foreign currency. And of course, also the consequences of that is the increased external debt service payments for our African countries. The third one was the political instability, let's say the coup that happened in Gabon. So this was the main drivers for the key rating action that I have presented. When we look at the Eurobond market, Ethiopia was the third and latest country to default on its debt payment. And also, you will notice that no countries in Africa actually issue a sovereign bond during that same period. And one of the main reasons being the high cost of borrowing. So what are the key issues that we have assessed during that period? So one was, the rating and commentaries done by the big three. And also, I would say the fact that Nigeria, notably, and Kenya disagreed with such view. The second was the fact that S&P decided to drop its ESG rating score. And one reason being the fact that investors were not really confident about how to use the ESG score and how it could actually affect the investment decisions. The third one was a misalignment in terms of how we define default, and notably that was the case for Cameroon. There was, I would say, challenges because it was claimed that Cameroon was not able to pay on time, and that was being perceived as a default. And finally, and this is also linked to the issue in Cameroon, the failure to timely verify the information before the rating action. So when we look now at our market for domestic credit ratings, so we can mention that the Financial Regulatory Authority of Egypt received applications for 3 entities: MGM Financial and Banking Consultant, India's Informerix Rating, and Belton Capital. So we also see an increased interest of emerging credit rating agencies to start, assessing our African countries with the idea to provide an alternative view, an alternative perspective. And of course, we can also mention that, sorry about that. So we can also mention that Care Edge Rating Africa actually launched its sovereign risk assessment framework with the idea to expand into the sovereign credit rating space. What were the key recommendations? First of all, to credit rating agencies. One, to verify the data before publishing any rating opinion, as we have seen for Cameroon. Two is to be very specific about how they defined default events. To government, we had also 2 recommendations. One was to better engage credit rating agencies. And this has been a point that we have been raising through our different reports. That process needs to be properly monitored, and this is really important. And finally, improve treasury management. So if our countries are able to better, manage the cash, they can also better anticipate when there will be liquidity pressures and how they can deal with that. So additional recommendation was also to locate again more analysts on the continent, and knowing that this is really important for them to also, understand fully the dynamic of our continent. And of course, the rating calendar should include all all the rated African countries, so that they know exactly when they are going to be rated. This will end my presentation. Thank you for your attention.
Thank you, Sonia, for that brief and wonderful presentation. You have highlighted and unpacked the credit rating actions by Mood, Fitch's, and S&P's during 2023 second half of the year. And we have noted that out of the 23 sovereign credit rating actions, 17 were negative rating outcomes. Now joining me in this panel to reflect on the report is Prof. Daniel Cash, Ms. Hannah Ryder, and Professor Afrikaner Jerome. I'll start with Daniel. If you could please give us your reflections.
Thank you. So, Eddie, just some general reflections. Yeah. In terms of the report itself, there were signs of positivity, even though there was negative. It was outweighed by the negative. But since the report, there are more positive shoots coming out. So I believe Tanzania was upgraded last week, I believe. I think 3 countries have come back to the Eurobond market from sub-Saharan Africa. So there are signs of positivity after the report. Just a clarification from me, there was mention of ESG ratings and S&P's ESG ratings. I think it's worth clarifying the terminology that ESG ratings and ESG scores are different. What S&P dropped was its ESG scores, which was attached to the credit rating to try to demonstrate how they had incorporated ESG and its effect on the rating. That's different to the ESG rating products, which are in a separate market. And the other thing as well, the calls for standardization across the default definitions, I think, are rational and valid. I wouldn't understand why they were made, but the chances of that happening are really low because it's very rare that the credit rating agencies are told how to methodologically change and then accept that. So I think the only one that comes to mind really was post-financial crisis, where they had structured finance ratings and they were told to add addendums to that to make it clearer for the marketplace, but that was it. Regulators very rarely tell rating agencies how to methodologically develop. There are a number of reasons for that, but it's very rare. I think what they would argue is that their default definitions are made public. It's up to the market to make sure that they understand what they are before they engage. And the last thing I wanted to note was on page 11 and the recommendations, I can't back those recommendations enough, and especially, and it is certainly not my intent to pontificate to any country in the room, but investment in engagement is critical at this point. Being in the game and choosing not to participate means you're still in the game, you're just choosing not to participate. That investment is critical. And believe me, I'm not flogging my wares here for work because I'm busy enough, but investing in research and advice that you've invested in is critical because what tends to happen is when a country, let's say, issues a Eurobond, the investment banks that are underwriting that Eurobond will provide their advisory services from a credit rating perspective, but they're usually not really adequate. They're from the bank and from the bank's perspective, and they're not for the country's development. They don't have that in their forefront. So my suggestion is that countries, and I understand and acknowledge the difficulty of talking to a country that's suffering financially and telling them to invest, but investing in essentially raising the knowledge floor when it comes to credit rating agencies at this point in time in the market's development and the way the Bretton Woods institutions have moved away from funding and it's now the capital markets that are coming in is absolutely vital for the development of the African continent, that that knowledge floor is raised so the countries know what they're dealing with. They're not entering into this situation, not necessarily blind, but without all of the protection they need. So yes, I think the last thing I'd say about this report, I'm a really big fan of these reports because what it does is something which I've been banging the drum on for years, and I know people like Mishek have been doing so. I'm really thankful that it raises this issue of the importance of credit rating agencies. I know I'm a bit of a credit rating nerd, but I'm in a room full of them, so we have to keep putting this at the forefront. If you're dealing with the capital markets, you have to deal with the credit rating agencies and you have to understand the underlying dynamics. So that's all from me.
Thank you so much, Danielle, for that intervention. Yes, APRM has been publishing this report for the past 4 years, and we will continue to read the issues to analyze critically, what are the drivers of the rating actions, and what are the key recommendations that governments and as well as rating agencies, should look into. I will now move to Ms. Hannah Ryder, who is the CEO of Development Reimagine, to intervene. Thank you.
Thank you very much. Can you hear me? Yes. Thank you again for having me on this panel, and congratulations to both APRM and UNECA for the publication of this. Like Daniel, I think it is very, very important to have these sorts of reports which focus on the African situation we have to really understand what's going on for us in order to be able to work out what the next steps are, and as well as the sort of commonalities and overall drivers. And I think it was interesting in the report, this question of the drivers, of what were the key changes, why were the key changes that happened. And I think they the key changes that did and didn't happen illustrate something about 2023, number one, and also about the response of international credit rating agencies to African situations in general. And first of all, 2023, we have to also remember that that was a year in which there was a lot of imported inflation, as it were, both in terms of imports. A lot of African countries, of course, we remain quite import dependent, and also at the same time, where we are exporting, many of those goods are not necessarily rising in price significantly. And also other changes around interest rates. For example, we saw SDR interest rates increase and so on. So those were also some of the drivers. It's not just foreign currency shortages, for instance, it's other external drivers that lead to those foreign currency shortages. It's not just what we're doing internally. And it's in many ways, it's sort of Africa's external dependence, which leads to some of these issues. At the same time, we've also got to look at some of those things as sources of resilience. And I think that's where a lot of the misinterpretation from credit rating agencies comes, really not understanding where African resilience actually lives and exists. For example, parts the continuing function of the informal economy, cross-border trade, all those sorts of aspects actually do create a good amount of resilience and do mean that we can avoid default in quite challenging circumstances, perhaps in many cases where others might default. So I think some of those drivers do illustrate that lack of understanding, both about sources of resilience and again also about sources of growth. We've got to remember that also 2023 was a year in which African growth outpaced the rest of the world's growth. Again, not something typically publicized very clearly by the Bretton Woods institutions. But if you go to the African Development Bank, of course, the African Development Bank will be talking about that. And also 2024 will be a year in which African growth, again, outpaces the rest of the world. We have a number of countries who are growing really fast. And again, that should be incorporated into overall questions around, yes, credit rating agencies, I know, are not looking at growth, but it should be incorporated into default risk assessment, but it's not necessarily. And then again, that aspect around interpretation of events. Again, I think the report illustrates issues around interpretation of events, security issues, where there are military coups, yes, but does that mean that the country is necessarily on a path to default? No. It might mean that a country is on a path to a different relationship with foreign investors. Does that lead to default? Not necessarily. It might actually drive up, it may well in future drive up the likelihood of growth and a change in the economic system in those countries. So we cannot always just generalize about those sorts of events. And I think, again, the report illustrates the problems of doing that. That notwithstanding all of that, I think Daniel's right to say, I'm sure the 2024 outlook will be better. But from an African perspective, I'm not sure that that's because things will have necessarily been significantly different, but it may be because the international community, for some reason, suddenly thinks differently about us. Good, yes, but let's keep on pushing for actual fundamental change. Thanks.
Thanks, Hannah. I will also share that sentiment. We hope to have better outlook in 2024 and better ratings for Africa. I now invite Mr. Jerome, the Professor Jerome, to take the floor.
Thank you, AG. Let me begin by thanking the APRM for the invitation to discuss this 8th edition of the Bahama Report, the African Sovereign Credit Rating Review. Invariably, the report is very concise, only 11 pages, but full of very useful information. As we have been discussing since yesterday, the general trend, just like we heard from the presenter too, was one of negative rating, including downgrades and negative outlook, which continued in the whole of Africa. There was general tightening of the capital market for Africa to the extent that no African sovereign euro bonds were issued during the period under review. Following closely, the two countries that were able to issue bonds in the first half of 2023. Looking at the situation critically, it's as if this onslaught is not limited to just countries or sovereigns, but is gradually spread into our institutions. This is reflected in Moody's downgrade of African Export-Import Bank to BAA1, negative in February 2024. And the change in outlook from from stable to negative. If you look at the reasons, not far-fetched, I think the only crime of Africa Export-Import Bank is the type of countries they are dealing with, if you go into details. But looking at the other factors, I don't think it's deliberate. It's the way they work. The reasons are not far-fetched, as we heard from two of our other presenters, so I don't want to repeat what they've said. But let me draw our attention to two developments in that period under review that may be of interest to us. Incidentally, during that period, Fitch rating downgraded the long-term rating of the US government, which is unimaginable, specifically in August 2023. And that was due to the political tension. I tried to look at the list. I think the last time the US government was downgraded was in 2011. I could not imagine this happening under Trump anyway. So what this simply shows is that it's not as if they are targeting Africa. But perhaps what was more interesting to me was the reasons which they alluded. It suddenly reminded me of Mish and the group, AG, the way they would have reacted. Because the US Treasury Secretary, Janet, they complained that the downgrade was arbitrary and based on outdated data. This is the sort of thing you will hear from Africa. So it was very interesting. The second order development, which I think is very, very important, is the June 2023 IMF working paper on sub-Saharan Africa. I mean, several people in this room have commented on that particular report. The title is Sub-Saharan Africa's Risk Pyramid in Search of the Missing Factors. I mean, this is the first empirical evidence that is sort of supporting this general trend that Africa has been unfairly punished. It supports the hypothesis at this point that we'll be making. What was very interesting to me was that the authors analyzed the drivers of the extra cost and argued that several structural dimensions were responsible, including the transparency of the budget process, the importance of the informal sector, though I did not quite understand how informality came to the picture, as well as the quality of public institutions. Invariably, let me turn to this particular report now. While concise, as I mentioned, the edition, like other previous ones, is very well written and informative, and I very much enjoyed reading it. I just have some few suggestions on how they can take it forward, because it's like becoming the voice of credit rating in Africa. The first point, I mean, like under this period of that review, the major development was that Ethiopia became Africa's third default in December 2023 after it failed to make a 33 million coupon payment on its only international government bond. I would have explained this, expected this particular edition, at least to explain that very well, what it means. This is like the African voice for rating. The second suggestion is that I think this report, as much as possible, should be using every opportunity to preach to the 22 countries that I would say that are still allergic to rating in West Africa, in Africa generally, whether 22 by AU definition or 21 by UN definition, including stating clearly the requirements of rating agencies in terms of information and data, so that member states can improve their preparation for credit rating. I also want to bring to the fore, which our CEO made yesterday. The APRM is concerned about good practices, and I would like to see a section of this report devoted to capturing some good practices for the purpose of encouraging learning, at least until you become independent from APRM, then you can decide to move forward. There are several of them. The first one, for example, Fitch assigned Tanzania a new B+ rating. They move up from B2. I mean, it's good to look at the reason. And this is a good practice, which would have encouraged some of these countries. Another one during this period, I mean, which you can report in the next edition, is the case of Ivory Coast or Cote d'Ivoire, which was handled Africa's second highest credit rating in March 2024. The credit score was lifted one level to BA2, 2 levels under investment grade 2. And Modi cited the resilience of the economy and rising private sector investment. That's what things we would like to see. With this trend, you find that Ivory Coast joins South Africa as the highest rated sovereign in sub-Saharan Africa, with foreign debt outstanding. Like I said, I very much enjoyed this report, and I hope you continue this trend. Thank you.
Thank you so much, Prof. We really appreciate your recommendations and suggestions. We'll take them into consideration in preparation to the next reports. I will now open the floor for questions and answers. Yes, Prof.
Oh, thank you very much. Good morning. Thanks very much to the panel for very coincides and you could say very thought-provoking response to this report, and also to commend our colleagues who put together this report from the ECA and also the colleagues at the APRM. Just a little bit about the history to this report. It started as a monograph of some sort, and its level of ambition was quite modest, and now it has evolved. And I take the point that were raised by some of the distinguished colleagues on the panel about the need to lift it now, to raise the level of ambition in the report. And I will start with incorporating it now properly. One is to set up maybe an advisory group or an editorial group. Like when I'm listening to colleagues here that you could benefit from the network that you have already established, associate them with the content. If you are taking this out twice a year, then you've got enough time to enrich the content. So you could have a team that generates the drafts, etc. And you could also fill submissions. That's what Jerome is saying. And then subject this then to some sort of a validation through either an editorial group editorial committee or an advisory group. So you need to have an advisory group or editorial that more or less mirrors the kind of attendance you have today. So it should not just be Africans on the continent, even though all of us, we love our continent, but try to give it also a global presence. And then also, so maybe I sound irrelevant, but things like ISBN now, we must start working now on the ISBN. So it must be registered as a publication. But the most substantive point I wanted to make is try to build, use it to generate debate, discussions across the continent, among the regulators, member states, other actors, and so on. So you need to have behind it some sort of a strategy, and you need to have behind it a network. So my suggestion will be that we work together with the ECA. We try to find resources and find an institutional partner. We are already institutions. Somebody who can give us resources to convene meetings of the advisory group and for some of the field work, because some of the field work, but it must be properly launched. And launch, I don't know, the ECA meetings. ECA, they have meetings of finance and planning ministers annually. We can use that. We must, so you have to build it as a global, as one of the important voices in the debate about these issues that are contained in this report. So what I'm suggesting is that we started this as a monograph, quite modest, but it has been able to grow a little bit of its own and develop its own life. But perhaps now that we are where we are today, the next one, we need to lift its level. We need to lift this level and I think some of the panelists are saying that let's populate it more. Well, it's nice to have 6 pages, but 6 pages maybe of the executive summary. So let's try to grow its content. Let's bring in more data and so on. Let's make it a major publication coming out of Africa on this issue, but build a constituency around it, build a reflection group around it, launch it, and raise the level of, take it to the meetings of central bank governors, because there is no point in doing such a brilliant work and it's only read by me and you, Eji. So it has to be used and it has to be cited, and then it's something that I think that now in the next phase, we should put a lot more effort into it. And I thank you very much, colleagues.
Thank you so much, CEO. Questions?
Yeah, thank you very much. My question goes to some of the information in the report insofar as Cameroon is concerned. There was an indication that there was a likely default of Cameroon, but it really didn't happen, and there was a reporting that it had happened. Perhaps if somebody can shed a bit more light on exactly what the circumstances were, so then we see what the level of objectivity that there was is. Thank you.
I will give Sonia to reflect on that, but let me get more questions from the floor, if there are any.
Perhaps just building on the comments that just came through from the CEO, I think there would be a benefit of making this more regular. And question, is there any intention to make this an annual product? I think a biannual product just risks being too much of the data is just history.
Okay, Madam Anne.
Thank you. My name is Anna Masiku, member of the National Governing Council here in Zambia. Is there a component of quality assurance in the process of report writing, which should compel the credit rating company to conduct a briefing with the institution or country that is being rated in order to discuss the findings with a view to establish the accuracy of what is being reported before publication? I submit.
Okay, I'll invite Sonia and then I'll report.
Thank you for the question. So basically, Cameroon was late on one of its payment, and basically, I think the payment, everything was solved within 18 days. And normally, to be treated as a default, there is a grace period of 30 days. So this is basically what happened. So according to the government and based on the latest analysis done by Fitch, the delay in payment was solved within the grace period. Thank you.
Thank you, Sonia. Just to respond to the question of quality assurance, indeed, the APRM has got a team of researchers who ensure that the report is factually correct and a true reflection of what's happening in the ground. So there is that committee that is in the APRM Continental Secretariat. And Tim, I think we've taken your comments as well to make the reports more regular. It's on a biennial report. Thank you. Let me come back to my panel. If there is any last words that you would like to share with us, feel free to do so. Are we all good? All right. Okay. So please help me thank my panel. With a round of applause, and we'll proceed to the next panel. I think Sonia, who's taking over from me? Okay, Jean-Marc will be chairing the next panel.
Good morning, everyone. I'm Jean-Marc Kilolo, economist with the Economic Commission for Africa. So welcome again to this sixth session on rebalancing investors' misconception on Africa. Let me invite our panelists. We have one online, Mr. Gregory Smith, senior economist with the World Bank, will be joining virtually. We have Mr. Bilal Bassiouni, I think he's among us. Mr. Bilal, can you come up front? He's the head of risk forecasting at Pangaea Risk. I will also invite Mr. Christopher Egerton Warburton, founding partner of Lion's Head Global Partners. I think I saw his tag yesterday. Is he among us? Yes. And finally, I will invite Mr. Saleh Mohamedi, Country Credit Director, National Bank of Commerce Tanzania. Karibu sana. I don't know if IT can advise if Mr. Gregory Smith is connected. Not yet? All right, so just point to us when he's ready. So this sixth session is about rebalancing investors' misconception on Africa. So I raised a few questions. Probably some of those will be addressed by our panelists. Otherwise, I know that we have a bunch of experts sitting in the room, some of which are just gazing at me. So I think that they will bring also insightful information for discussion. So the first question while reading this theme is there any misconception? What are we talking about? So if our panelists can shed light on that. The second one is rebalancing. How do we go about rebalancing? What needs to be rebalanced? And when you read the title right below, it says in the context of an Africa credit rating agency. This session will discuss key factors that could address the high risk perception in instruments issued in Africa. What are those key factors? High risk perception. Instruments. We know that across the continent, several African countries has shallow financial markets. Is it also an issue to be addressed in order to rebalance investor misconception, financial death? And if this is an issue, how do we need to increase this financial death and broaden up the type, sorts of financial instruments? We know also that the same causes yield the same results or effects. What will be the Africa Credit Rating Agency doing differently? How it will differentiate with the big three, the three major international credit rating agencies? So those were the questions that came to my mind when reflecting on that topic. IT, is Mr. Smith ready? Can somebody advise? I can't see. There is a pillar in front of me, so IT? No, it's not. All right, so let us give the floor to Mr. Bilal. So maybe you want to introduce yourself, say a few words about your institution before you express your opinion on this subject matter. The floor is yours.
Thank you so much, Mr. Chair. Good morning, everyone. Of course, it's a pleasure being here, and I think the discussions we've been having all morning have been extremely insightful. And I think also discussion has built us to now as a useful platform to different element around credit ratings, and also look at a bit of country risk and how assesses a country's ability to meet its fiscal responsibilities, particularly towards investors in business or external players onto the continent. I think also it is useful just to differentiate what's the difference between country risk and that of credit rating agencies and the roles that they play. Now, country risk, in terms of methodology, will utilize both qualitative and quantitative methods to assess political, economic, social, governance, legal, regulatory, and other perils, and how those impact businesses and investors within a particular jurisdiction. So it's a much broader spectrum of risks than that which is focused solely on just creditworthiness or the country's ability to meet its debt obligations, which of course CRAs do. The following slide, please. And if we look at an interesting case study from the continent, such as South Africa, and how country risk is a more useful tool to understand, these perils that I just spoke to you about. Of course, as we know from our discussions yesterday, political risk was one of the highest concerns that investors had looking into the continent. Now, South Africa is a useful example of how political events can skew or impact short-term fiscal issues, which sometimes credit rating agencies fail to understand in the long-term scope of things. Because there's elections coming in 2024, apologies, the government has undergone a massive campaign or a massive social spending campaign, and also an increased level of imports of diesel to be able to meet its power demands. Of course, South Africa has been going through power shortages for a very long time. This has put a massive drain on the budget and a massive drain on the state coffers. But knowing how policies move into South Africa and knowing the historical context, what we expect is that the government will implement austerity measures and return to the reforms that it has implemented post-elections. Credit rating agencies may not necessarily see this in the context and within the dimensions of things, and sometimes the focus is only short-term. The next example is Egypt. I don't think since I've began doing political risk analysis about 12 years ago, a country change its fortunes within such a short time as much as Egypt has. Just October 2023 last year, Egypt was ranked second highest country or second most likely country to default after Ukraine, which is in war, right? Within the space of 2 weeks, Egypt generated over 50 billion US dollars and managed to turn its outlook from negative to stable in an extraordinary fashion because of dimensions and factors that credit rating agencies don't necessarily take into consideration, such as geopolitical issues, geopolitical considerations. Egypt's role and its too big to fail position in the North African continent makes countries and institutions more willing to assist Egypt turn its fortunes in other places. So has credit rating agencies really treated Africa unfairly? From a country risk perspective, absolutely. This is something that is, unnegotiable, or something that we've established since our discussions from yesterday. But if we look at some of the finer details of where we can see this, where this becomes more and more stark, is of course, if you're looking at just purely economic indicators, which of course the credit rating agency does, even in that case, for instance, Argentina is a habitual defaulter, right? We all know this. It is still rated much higher than countries in Africa that have never defaulted. On what premise has this been based on? Also, the focus on short-term macroeconomic indicators, forgetting the long-term trajectories of countries and the potential of countries to overcome the fiscal issues. Additionally, the focus only on Eurobonds as an indicator. So credit rating agencies will often use Eurobonds as this sole benchmark or barometer to assess a country's ability to pay its debts. Of course, countries are going to prioritize fuel, food, even payments to the World Bank and other multilateral institutions, then prioritize Eurobonds. Like a country will likely default on Eurobonds firstly. Again, Cameroon only defaulted for 1 day, right? And that was enough to place Cameroon into the defaulting list. But within the wider scheme of things, okay, this map here represents the country's highest risks. So, for instance, some of the red it's not necessarily in Africa, is not necessarily linked to its credit worthiness or sovereign default ratings, but other risk perils that we've spoke about. But still, we have to equally benchmark Africa to the rest of the world. And with Tangier Risk, we do cover risk ratings for all countries in the world with a focus on the qualitative and quantitative analysis on Africa. And we believe post lots of elections that we're seeing in Africa and the continent, actually 50% of the world population is going to elections this year. About over 21 countries in Africa going to elections as well. Post elections, we believe that a lot of the indicators and the perils that we've seen at the moment on a high, on elevated level will start to come down and producing a more benign investor position and outlook for Africa. And we also look at, we produced a world map looking at political risk. And of course, this takes into consideration the perils that we've just discussed, including sovereign positions and other regulatory and political risks. Finally, if you would like to access to this presentation or would like to communicate further, please scan the QR code that you see on the screen, and we're more than happy to engage. But again, we just need to emphasize once more the importance of providing clarity around the risks associated with investing in Africa, so that investors are not averse to investments and to the opportunities that the continent presents, but they do understand it, and they are transparent, and they are also at the levels that they need to be. Thank you so much.
Thank you very much, Mr. Bilal, for your very insightful presentation. So I picked up a few elements. You first develop on country risk, several dimensions, be it political, economic, legal, regulatory, and social. You also emphasized what economists call political business cycles, meaning that when the elections are right at the corner, government will be spending more, of course, to keep their incumbency. You mentioned also the too big to fail position of Egypt, also a well-known phenomenon by economists, so that international institutions will try their best to salvage a big country to avoid any systemic crisis. You also alluded to Argentina, a regular defaulter. However, its credit rating is higher than most of African countries that are non-investment grade at best, if not rated speculative. You also alluded to the focus by credit rating agencies on Eurobonds, whose probability of default is higher compared to other assets. And you contrasted Argentina case with Cameroon that defaulted for 1 day and was downgraded. A question, though, maybe our other panelists will react or respond to. So Africa is non-investment grade at best. But when it comes to exploiting its natural resources, somebody said yesterday that Africa hosts about 20% of global resources, so there is no problem. But when it comes to investing into transformative or industrialization, then that flag of non-investment grade, it's very hard, and it's very difficult to attract investment. So, Mr. Christopher, what's your thoughts on this issue?
Thank you. Can you hear? Is this working? Yes. So firstly, may I start by thanking everybody for the invitation to be here. I've visited Lusaka over the years a few times, not enough times, but a few times, and it's amazing to see the change that has taken place here. The roads look the same, but there's a lot more cars to be visible, which is a sign of how much the journey that Zambia is on and how much things have changed here. So let me give you 2 seconds of background because people probably don't know me and they don't know who I work for. So I have a ridiculous name, Christopher Edgerton Warburton. So everybody has always known me as Edge. Please, that's free to use. I started my career actually as a biochemist, but got sucked into investment banking at Goldman Sachs. And the first project that I was given to work on seemed a very long way away, to work on the rating of a country called South Africa. This was in 1992, 1993. South Africa was heading to the historic elections of 1994. At the time, was just beginning to reactivate its engagement with the international market, and the bank that I worked with, Goldman Sachs, had the foresight to work with several of the prominent members of the ANC who were in line to become the finance minister, were in line to become the governor of the central bank, etc. So here I was a biochemist and I was handed this challenge working with this Canadian guy who some of you may have heard of called Mark Carney. And we sat down to try and persuade the rating agencies of South Africa's credit. Since that time, I mean, we managed to get an investment grade rating from one of the rating agencies, and the other one was nearly investment grade and capitulated and upgraded South Africa shortly thereafter. And Bilal was involved in some of this stuff. I think you were at the Reserve Bank at the time or working in South Africa. So this has been a journey that has gone on. Then after 15 years at Goldman, I was running the sovereign supra business, and I was set a challenge by then Chancellor Gordon Brown and one of his colleagues, Shriti Vadera. And they wanted to increase the capital flow for the Millennium Development Goals. This was back in 2008. And they wanted to create a new financing instrument that would significantly increase the volume of flows, but it had to be off balance sheet for the respective countries. And so working with the UK Treasury and the French government, we developed a new instrument, the International Financing Facility, which then got attached to a new program for vaccination in Africa called Gavi, which had just been set up. And that was providing vaccines to the 72 poorest countries of the world. So we were told, how can we create a financing mechanism that would be linked to enable the rollout of these vaccines to the 72 poorest countries of the world, but it couldn't be linked to the balance sheets of the donor nations. So, and the last challenge, they wanted it to cost exactly the same as borrowing from the World Bank or the EIB or one of these other things. So, I mean, this is like being put up in this attic and given the Rumpelstiltskin task of spinning gold out of straw. At the time, I think there were about 5 African countries that were rated. And we came up with a plan, which was to link the cash payments from the donors to this portfolio of the 72 countries and their default or not default to the IMF. So if you think of the likelihood of default, you have your corporate defaults, then you have your sovereign default, then you have your sovereign defaults to the MDBs. And then last but not least, you basically throw in the towel and you tell the IMF, I'm not paying you. Being in default, you're never actually in default to the IMF. You're in long-term arrears. They have a nicer way of dealing with it. Doesn't sound so bad, but it's pretty effective. Now, so how do you assess what is the probability of all of these countries going into long-term arrears with the IMF? Well, it wasn't heavily publicized at the time, but we together with Fitch, Moody's, and S&P, shadow rated every single one of those 72 countries that were not rated. So they took all these countries to credit committee, and I can tell you that we ended with an average rating of B- for the countries that were in Africa. Now that led to a structure where IFM was able to issue AAA bonds, but it had to commit to maintain a cushion of 30% at all times in terms of the present value of those cash flows to cover for expected defaults that were meant to happen with these countries to the IMF. So what the rating model was basically saying that over this time, over the course of say 20 years, 30% of these cash flows with these countries would be in long-term arrears to the IMF. So recently, I was asked to come back, and we all know that this rating agency issue is a challenge. And with the support of the US government, we were asked, Edge, can you dust down some of your old rating agency activities and provide some insights? So I went back and looked and said, okay, so how did the world look in 2002 when we were doing this work? And what happened? So here's the situation. In 2002, the average rating of the countries in Asia was BBB-. The average rating in Africa, as I said, was B-. Some of those were public. The public ratings average was BB-, but that was because you had Botswana, South Africa, but based on the analysis we did for IFM, it came out at B-. And Latin America was rated BB-. Okay, so I then look at what's the average rating today, and it's quite fascinating. Asia has gone up one notch. The average is now BBB. The LATAM was BB-, is still BB-. And Africa was B-, is still B-. Okay, so amazingly, when you look at this, I mean, maybe I was just lucky with the timings, but it's crazy how little has changed over 20 years when we've seen a lot of economic change in that time. So I then said, so how many countries in each of these regions defaulted? In Asia, we had 12% of countries there was a default or a credit event, let's call it. Okay. In Latin America, sorry, in Africa, we had 21% of the countries. And this is going right up to date. I included Ethiopia. I'm trying to be as beastly to Africa as possible. Okay. In LATAM, we have 46%. Basically, half of the countries that were rated in 2002 in Latin America defaulted. And so Argentina only gets to count once. And Latin American countries are great at defaulting multiple times. Okay, it's like chapter 11 in American, for an American corporate. So then you say to yourself, what did those ratings imply? Well, a rating of BBB to BBB- implies that 10% of your countries are going to default. If you had a portfolio over a long term, a BBB rating implies that 10% of your countries are going to go default. So in Asia, they kind of got it right. Okay, in Africa, the default rate would have, Africa's ratings should have been, the average should have been BB. And LATAM should have been B-, because that is the probability that's implied by that average rating. Now, why does anyone care? And I think this is very important. It's very important for an African credit rating agency. It's very important for all of the credit rating agencies here. People think of credit rating agencies as sort of almost like static things. But I'm a weird guy. I come from the bond markets, so please don't hold that against me. The bond markets are basically looking into the future because we're lending for 20 years, 30 years to these countries. So you're desperately trying to go to predict what the future is going to look like. And of course, you go to the rating agencies as a way to predict what the future is going to look like. Now, trust me, if you read those ratings reports, they have long disclaimers telling you this is no good at telling you what the future is going to look like. But that is what they're used for. And it's important because they're not just used by investors, they're used by the regulators. So if you're a bank, you now are subject to Basel III. you have to hold your capital against the risk of the assets that you hold. So if your asset is B- rated, then you need to go and figure out how much capital do I need to hold? And here's a really nasty sting in the tail. That curve is not linear. That curve gets steeper. So a 1-notch difference at the back end of the curve has a much bigger impact than a 1-notch difference at the front end of the curve. Okay? So, and it's not just the banks. If you're a multilateral development bank, you're driven by the same thing, because the MDBs issue bonds. They want to issue their AAA bonds, which is they get fantastic funding. But the price they pay for having those AAA ratings is that they use the same methodology to analyze the countries in their portfolios. So they go country by country by country. So a single B rating is impacting all of the capital that is available for the country. It's impacting the official capital. It's impacting the private capital. So this stuff really matters. But what I'm saying is that when you, as a rating agency, put out a rating, you're effectively saying, I think that the probability, the risk here is blob. And I think, therefore, as an investor, you should charge for this risk accordingly. And the reality is we can look. I mean, the prediction today, based on the African ratings, is that there will be one African country defaulting every single year for the next 20 years. One a year. Boom, 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 boom. And the reality is for the last 20 years, this just hasn't been happening. So there's a part of me which says Africa clearly is in some distress at the moment. Debt levels have been rising, but it's almost like they've grown into their ratings. They've been paying the price of these weaker ratings for the last 20 years and paying those higher coupons, which translates into billions of dollars. I mean, this is not small stuff for kids. But it also matters because the reality is Africa's growing like it should, and like every other continent grows. And as you grow, you need to suck in capital. And that capital is not going to be coming from the MDBs. Trust me, they would love to lend. They are lending as much as they possibly can. But they are also very keen to keep their AAA ratings. There's this whole debt review stuff going on, and that's fine. But the reality is Africa's growing at 7-8%, or we want it to grow at 7-9%. The MDB balance sheets are not growing at 7-9%. So by definition, Africa, all these countries need to suck in more international capital from the private markets. That's not a bad thing. That's a normal thing to happen. But if that capital is being sucked in at a very high cost, then it's like you're running a race, but you got rocks in the back. So we talked about what can we do about this. It's very hard to go to a rating agency and say your methodology doesn't work. Okay, trust me, lots of people, including the US government, have tried and failed. Okay, but for us, it's about taking away the planks of that argument. And what we noticed is that in the past few years, there used to be a lot of banks, including Goldman Sachs, and JP Morgan and others, who used to go and work with countries and support them in their dialogue with the rating agencies. But this was provided as a sort of free service by most countries, to most countries. And one by one, they've all stopped doing it. Standard Chartered was the last bank that did a lot of this. And basically, the CEO walked into the team and just fired the entire team about a year and a half ago. So African countries have been left without the support that they need to, as it were, take on those rating agencies. At the same time, the data needs and the requirements for what the agencies require is going up. And because there is less issuance out of Africa, trust me, these guys are just commercial. They don't put their best people onto the projects. They don't allocate it. So it sounds crazy, but and Daniel mentioned this, you do need to invest in giving the agencies what they need. And you kind of need to partially digest it. They can't eat it as raw food. You have to provide it to them in an edible format. So what we've done with support of the US government, and this will be available to everybody, is we said, what is the black box? And trust me, the black box is very black. But it is discernible because they've had to publish their methodologies. And the black box is also weird. There are in times when there are conflicts in the black box. There are things which make no sense at all, like there's a huge weighting for GDP per capita, which basically says if you're poor, you're screwed. I mean, you're always going to be running with the rock on your back. And if you're rich, you're sort of AAA. I mean, this has nothing to do with your ability to service your debt. They also use historical averages for a lot of things, which mean that it's very hard to improve. If you're a minister and you come in, a new finance minister, but you're not going to see any change in your rating for 3 years based on the activities that you're doing, you're going to be out of office before you see any impact. And lastly, they don't take into account, as many people have discussed, things like natural capital. So we need to try and get them data. We need to get them data that's accurate. We need to give them the information and make it easier for countries to make their own case. Because the reality is you shouldn't have Goldman Sachs telling a rating agency what you should be rated. A country should be able to stand up and say, this should not be so complicated. You have great economists in every central bank, in every Ministry of Finance. And I've been on roadshows with these Ministry of Finance people for my entire career. Everybody can explain this stuff. But what they don't know what they have to explain, and they don't know what data these guys need. So we've created a portal. This portal will be open source. We ideally want to have it essentially suck up all of the data as it's produced. So when a central bank releases, or a Department of Statistics releases that inflation number, immediately it would be on the portal. No, at the moment, these agencies sit around and wait for the World Bank to update their report, which they do once a year, which means you could be getting rated based on 18-month-year-old data. So what we're seeking to do is create a way, so one, data goes up instantaneously. Two, it's very easy to compare between countries, both within Africa and outside Africa. How do we look relative to it? Where are the holes? What data is not being provided? There's lots of technical assistance to support a country to add in those data pieces that are missing. But up until now, no one really knows what's missing, what's not missing, because the black box was a black box. And lastly, we need somebody who's going to act as the policeman for this data repository. At the moment, we've been in closest discussions with the African Development Bank. We do think it's important that there is a party who, I mean, as I said, all the data should just go up automatically. But things happen, GDP gets rebased. You have to go back and change all the numbers. Who's going to be doing that? And I think who's the policeman who's overseeing this? I think lots of people have mentioned it's critical that these sorts of activities are in Africa, policed by Africa, moderated by Africa. And so, you know, we think that the AFDB, because they've got economists in all these different countries, actually could play this role quite well, but they're not the only person who could play this role. There are others. And that's open for discussion and debate. So this is coming. We're producing this. We've heard from lots of people here, data. I can just say we're working on the data, and there will be a tool. It's going to be open source. It will be available to everybody. And we hope that will be valuable to this conversation. But lastly, just say, I think this is a really important strategic initiative. Africa needs to capture this capital, and getting an African credit rating agency that is credible, that is respected by international investors, trust me, it will take on, because if they have better insights and better knowledge than S&P, Moody's, and Fitch, those investors are not stupid. They will read the report that they put the most faith in. At the moment, I would argue there's only one credit rating agency in Africa that anybody takes any notice of at the moment, and it's not a credit rating agency. It's the IMF. The only report that these investors are really focusing on at the moment are the Article 4 reports. This is nuts. We can change this, and I very much support this initiative to change the dialogue. Thank you. Sorry for going a little bit over.
Thank you very much, Mr. Christopher, for your strong message. Key takeaways. African countries has to make sure that they provide accurate data And there is an ongoing data repository initiative that should be fed with information automatically. It's important for African countries to make their case by themselves, not relying on IMF report, as it's currently the case for investors. It's also instrumental for credit rating agencies to publish their methodology. So now they are operating with a sort of black box. You don't know what is in there, how it's treated. So I think also this is valuable information for the nascent African credit rating agency. As Christopher said, this agency need to be reputable, respected, and also abiding to the highest standards. And also a very important point raised by Christopher, looking at the pattern of average score of Asia, Africa, and Latin America, not much has changed. And the current credit rating is not reflective of Africa capacity. So there is something there. The African sovereign credit rating should make it right. Thank you very much, Christopher. Very insightful. Let me turn to Mr. Saleh Mtaalam, utuoneshe kabisa mafikiri yako kwa ajili ya credit rating.
So I think, good morning, everybody. And I thank you, moderator. Thank you, APRM, for giving me this opportunity. I have been introduced, so I won't repeat that again. To me, I'll focus specific to the topic that has been put on the program, rebalancing misconception on Africa. When I look at it, let me start with the investors. What are they really looking at? Me, when I look at investors, they are looking at three key things. One, return on their investment. Second, safety, security of their invested capital. And thirdly, assurance that when these investments reach maturities, they will be able to be paid back their money. That is all what the investors are looking at. Now, in terms of risk perceptions, when you move on to Africa, there are numerous risk perceptions. I won't cover all, but I will go with some of the perceptions. Number one, which I see it as a key, is considering African continent as one country or one bloc. This, what is happening in one country within Africa is perceived to happen or in the future to another country. For instance, what is happening in Western Africa, we have seen the coup d'etats, but luckily of recently, we have seen Senegal, they have come out of that. That guys, to change the government, it doesn't need to go the military route. You can also go through the democratic way. The second misconception that I think is key is on the political stability. You can see when it comes the times of election, most of the investors are worried on their invested amount, capital. And we see chaos, we see civil unrest, etc. But not to all countries in Africa. Some of the countries in Africa, we can see a very smooth transition, which is a positive side, which we need to advocate. The other point is on the lack of reliable data. This has been covered. I will give you an example. When we were adopting International Financial Reporting Standard 9 on the computation of the expected losses, you find some of the products, they don't have data. So you use the proxy in other countries. I think that's not the right approach. So countries or through ACRA must advocate investment in the data infrastructure, including collection, data centers, and also the legal framework around this. The other key area is when you look at the African currencies, they are so volatile. So if you invest your capital in that currency, there is a risk that the loss might be higher apart from the fundamentals. Now, to address that, we need countries to come up with adequate fiscal policy and monetary policy, make sure that our currencies are managed properly. The final one in terms of misconception that I think is key is the skilled labor. It is perceived that Africa, as a bloc, we don't have much of that skilled labor. But again, when you look at along the continent, some of the countries have better human capital, which is coming up. And over time, this will be able to come through positive. Now, how do we balance? We have looked at investors, the misconception. In my view, ACRA has also a role in other credit rating agencies. Before going there, the assurance as well. One of the participants raised how reliable is the report that has been issued. And in my view, it's not only having a research team doing assurance. Maybe we can get someone independent outside ACRA to do assurance to make sure that, because this is a report which will be used by different stakeholders, include investors. And as such, that reliability or assurance on the credibility should be there. Now, to me, I think advocacy, awareness of these misconceptions and what is being done to address, that is number one, and is of top of priority. Transparency on the process, data, and the report as well. We have mentioned that assurance issue. And the last one is independence. I think when I'm an investor, I want to rely on the rating given by, say, ACRA. One thing that will come to my mind is ACRA independent. So that independence will need to be built. It can't happen over a short period of time, but over a long period of time will be there. And this will be coming through assurance works, through engagement, these forums, several reports, and investors afterward realize whatever they have relied on, they have helped them protect their investment, get an adequate return, and get back their money. So those are my contribution. Thank you. I will stop there for further comment. Thank you.
Shukrani, Bwana Saleh. So you raised a very important point regarding misperception. And what you said is that what happened in the African country tend to be projected to other African peer African countries. And this should not be the case. And that reminds me of Mr. Nonde Sichilema from the Market Supervision and Development at Security and Exchange Commission of Zambia, who said that though we share many features in common as Africans, but each country has its own trend and reality and need to be assessed accordingly. You also alluded to the importance of political stability, and you also insisted on the lack of reliable data. And you mentioned, and that I find it quite interesting, that when data is missing, people will be using proxies. Yeah. And as an econometrician, this is what I'm used to do. But if we can link this to what Mr. Christopher said, when you look at using proxy, usually will be either from other African peers or Latin American countries, which share the same features. But what Christopher concluded was that, though they can have the same pattern, but when it comes to credit rating, they have better scores than African countries. So something need to be addressed there. You also finally insisted on ACRA make sure that there is an in-house and outside quality assurance, and independence will be instrumental to build reputation. And this takes time. That will be done over time through engagements and several reports. I really salute your contribution. So let us move to Mr. Gregory Smith. I hope he's still online, senior economist at the World Bank. Mr. Smith, the floor is yours.
Thank you very much, and thank you for the invite. Sorry I couldn't be there in Lusaka, but I'm sat here in Colombo working on some other important debt issues. Like Zambia, they're in selective default and working hard to get back current on their debt and get that credit rating moving in the right direction. So I kind of bring three perspectives to my thinking on sovereign debt in Africa and credit ratings. One is my time at the World Bank on World Bank IMF missions over the years. Other times as an advisor to ministries of finance and debt offices. And lastly, my time in the market trading bonds. With that experience, I published this book in 2021, which is about African debt, where credit is due. And in that book, I write about credit ratings and efforts to assess creditworthiness. And one of my conclusions is that sovereign credit ratings, credit worthiness, etc., it's a complex business. There are many, many variables involved, from economic to social to political to market. It's a tricky business. And I think anyone who weighs into that area and offers an attempt at building a model, building a framework is very, very welcome. So I think there's a really important role for an Africa credit rating agency, but I think that while respecting the existing agencies of adding value, I think there's room for much more analysis in this space without trashing others. We need more information. And when I was in the bond markets, I used to read all the credit rating agencies' reports alongside many broker reports from the continent, African governments. We read incredibly widely, and I found little bits of information useful in all of them. So the story in my book about credit ratings is this is about 30 years old now. And Edge pointed to the South Africa rating, which I think was October 1994, so just after apartheid ended. So we've got 30-year history now of Africa credit ratings. Tunisia got the second rating in 1995. And then the interesting thing that happened around 2002 was there was this big effort to try and get more debut credit ratings. The US government spent a lot of money helping Fitch, and UNDP spent a lot of money helping S&P in 2003 to get these debut ratings. And by 2005, 17 countries on the continent have ratings. Now it's about 32. And we had like 7 IG ratings in 2010, but with the deterioration in credit worthiness, as from the perception of the main agencies, we're down to just a handful of IG ratings now. So we've got this 30-year story to study and build upon. And just as anecdotes, two of my favorite rating stories for Zambia probably are 2015, when Moody's downgraded Zambia from B1 to B2. And there was outrage from the Zambian finance minister. He declared Moody had got everything wrong. They were unwelcome. And it turned out they were right. The creditworthy was deteriorating fast in 2015, and there was a big jump in debt. But on the other side, I think the most interesting story is with FQM, a big mining company that is very present in Zambia. And for years, the conversation and all the investor calls for FQM was, we need to do more in Panama so that we can shift the rating to the Panama's rating and get away from Zambia's rating because it was much weaker. But in the end, it was the mine in Panama that got appropriated and shut by the government. The mine in Zambia is doing very well. So in a country with a very low credit rating, Zambia, things are fine. And in a country with a much higher credit rating, business was taken away. So it's a story that the credit rating agencies can also get things very, very wrong. So why I think these credit ratings are important is because they help understand cost of borrowing, and also and this could be in bonds with interest and loans, but it's also traders' risk limits. It's in private equity. The private sector lending arm of the World Bank, IFC, has its own rating system, but it weighs a lot on the main rating agencies. So even in making private equity decisions, these ratings are important. It's important for trade finance, etc., etc. So it's really important. And sometimes the credit ratings are ahead of the markets and moving market prices, and sometimes it's the other way around. The markets have moved in a different direction, and the credit ratings are behind. And I find that fascinating. So when I think about cost of borrowing, I think about several things. I think about the probability of default, I think about illiquidity, and I think about uncertainty. So the probability of default is art, not science. It's really hard to pin down that number, and I welcome all attempts, and I will read all attempts to try and do that because it's really useful. Illiquidity is something that is going to be on your price and cost of borrowing because you've not got many bonds. You've only got small bonds. It's very difficult to trade a Maldives 2026 Sukuk because it's one of the smallest bonds in the market. It's really hard to trade a Namibia 25. It's impossible to find it. It's illiquid. So you're always going to have a bit of premium on an illiquid bond. And then uncertainty, I think, is the biggest challenge because that's the unfamiliarity many investors have with the continent. And yes, over the decades, the media is much better. The UK Financial Times has gone from reporting on charity work to build a well to some quite sophisticated reporting about African nations. So I've seen the media improve over the last 20 years. Ministry of Finance websites are much better, and there are many more sources of information. And I think one of the key roles a Africa credit rating agent can play is just provide more, some public good information into the mix. And that, if it reduced uncertainty, would impact on market price regardless of the credit rating, because it would reduce that uncertainty premium for many people in the markets. So I think that's fantastic. So as a way forward, we're here discussing the need to address high risk perceptions. And number one is deliver on the reforms. There's a huge amount of work to do for better borrowing, whether it's the quality of debt management or simply the government policy that goes behind debt. So we've got a huge amount of work to do there. But in reducing uncertainty, I think that pools of information from the Africa Credit Rating Agency will be instrumental at informing investors and reducing borrowing costs. And then I think the biggest pressure on the main agencies will come from market pricing. So if the rating agencies are pricing, saying this is a single B, but it's priced and getting yields like a double B, then they're clearly wrong and will have to adjust. So I think this new information source, and if it does move the market price, will be incredibly useful at shifting and trying to move some of the agencies away from their bias. But in doing so, we shouldn't paint over how hard it is to assess credit worthiness, and we should respect others' attempts and complement them. That's all from me.
Thank you very much, Mr. Smith, for your very brief, though insightful contribution. So you said that assessing credit worthiness is a complex and tricky business because it has to account for several dimensions, including political, social, economic, and governance. You also shed light or stressed on the need for more information data. So I think that's a theme that has been recurrent during these meetings. You shared the experience of Zambia, was sovereign credit rating was revised downward compared to Panama, which has a better credit rating, though companies were running away. And then you shed light on the issue of credit rating being ahead of the market, or sometimes it goes the other way around. You also mentioned three criteria: liquidity, probability of default, and uncertainty. And uncertainty is fueled by the unfamiliarity of investors about the African continent. As a solution, you mentioned the importance of the quality of debt management and also the necessity of reducing uncertainty. And by reducing uncertainty, that will imply lower borrowing costs. So my own reflection on this, yes, there is uncertainty about Africa, but a lot of companies, international companies, invest in Africa without knowing, especially in the mining sector. I remember discussion about the Toronto Stock Exchange. You have pension funds, Canadian pension funds, and from other places investing without knowing. They just buy share in a mining company, Canadian, Australian mining company, but they don't know what is the final use of it. It goes to Africa. And I think that echoes what was said previously about making for Africa making its own case, because the market system is a complex one. So you may ending investing in Africa, you think that that's a very insecure, uncertain place. But to secure your future, your retirement, you invest in Africa. So I think that's also some of the elements that need to be discussed. So before I open the floor to the public, let me maybe ask our panelists to have a discussion among themselves. So Mr. Bilal, what's your reaction to Christopher's presentation? What you agree with, what you don't agree with?
Thank you so much, Mr. Chair. I think the panelists, and I thank them for all the interventions, have made very crucial points. Nothing I disagree with. I think I second most of the thoughts shared. Yes, I don't think I can disagree with anything from what has been discussed so far. Not sure if the other panelists have anything to.
Any comment? Any reaction to the other panelists' presentation?
Nothing I think of.
Thank you very much. Mr. Saleh?
No comment.
No comments? And finally, Mr. Christopher.
Okay, so this is, I feel like I should say no comment, but I have two comments. So one comment, I think it sort of came out, but I think it deserves more discussion, which is this difference between domestic ratings and international ratings. So, many of the sort of more developed countries, the rating agencies are quite nuanced in this difference. And, the rule of thumb when we were all at school was that you're AAA in your own currency because you can keep printing it, but you obviously may not be AAA in dollars. Now this gets complicated in Africa, and the agencies just it's like the fuse breaks. So take yourself, if you're sitting in the CFA, one of the two CFA zones, and it's interesting this case around Cameroon. The reality is it is really, really hard for a country in the CFA zone to default on their foreign currency debt because the reserves are all sitting in the Bank of France. And so technically, if you did default, an investor would just trot onto the, to the central bank in France and say, I want my money back. So it's like Greece. People don't understand. It was very hard for a single country in Europe to default. But trust me, the things that bind the African countries in the Francophone region together are way tighter than anything in the euro. But it doesn't appear. It's not there. Equally, in other countries, like South Africa has a very strong domestic rand market. The difference between where the rand's rated as a currency versus where the foreign currency, this is something which needs more unpacking, and I would hope that the African Credit Rating Agency could really become an expert in assessing domestic currency rating as well as the foreign currency. And then this other point that Greg Smith and Greg writes the best blog, by the way, there are many of us in the market who followed his writings for years. So it's very exciting to have him with us here today. But the reality is the market does give a signal, and the market oftentimes does turn around and effectively say, look, the rating agencies, you're wrong. And so getting investors to buy your bonds does help. But I've been working with a country for a long time who is single B rated, single B plus rated. They're desperate to become double B rated. You talk to the investors and the investors go, but you're so expensive because it's trading like a double B. But as far as they're concerned, it has to sit in their single B bucket. And as a single B, it looks very expensive because they can buy other single Bs which trade at a cheaper rate. So the reality is this stuff matters. And whether we like it or not, the more we can do to add to the database, to add to the information base, and to add to the discussion and provide counterfactuals to some of the status quo, the better for everybody. So I really second Greg's point there.
Thank you very much, Christopher. Gregory, any reaction to the other panelists' opinions? Any comment?
No, I found it all very insightful. Thank you very much. And I think that things are certainly moving on the right track with all this. And I think that that doing things in domestic currency is really important, because if you look at what really changes debt risks, how you get to investment grade when your borrowing costs reduce considerably. For example, right now in the markets, if you're an investment grade EM, spreads are incredibly tight, albeit with elevated yields because of where the US 10-year is. But to get to that holy grail of investment grade, you need to be borrowing mostly in your own currency and not abroad. So I think as these domestic ratings are so important, and anything that encourages countries to be more ambitious about their domestic borrowing in lieu of foreign borrowing, I think is incredibly important. And this is the work that takes years and perhaps decades, is deepening domestic markets, getting away from external borrowing. And that's the story of East Asia. They went through their crises in the late 90s, and then they said no more external borrowing. We don't want those jumps in debt. We're going to build up reserve buffers, and we're going to do things on our own currency. And I think that's the marked change. That's what gets you out of the frontier bracket and gets you borrowing at affordable levels, is that shift. So anything that you can do to equally inform and enrich and deepen domestic markets, I think is magic for the continent, especially as the fertility drops, domestic savings increase, and trying to keep African wealth invested in the continent is incredibly important. So any information to help investors abroad and at home do more in the domestic market, for me is a key ingredient of what I call better borrowing, and getting out of this. Many countries have defaulted over the years, and what tends to happen in their history, you go through a pattern of defaults and then you end up like Argentina, or you just move away from it and borrow in your own currency. So anything that can expedite that path and allow domestic markets to be deepened, I think is wonderful.
Thank you very much, Gregory, for your reaction. So I think that's comfort the work of ECA, Innovative Finance and Capital Market sections, as we assist countries develop their local currency bond. That's an effort that we have been doing with Uganda, assisting Botswana with its money market. So this is really instrumental. We have money, Africa has money, and what we have noticed across the continent is that the financial or banking system has excess liquidity that need to be used to finance development goals, SDGs. So let us open now to the public reaction, your reaction. So I see that Prof. Cash wanna speak. The floor is yours.
Thank you, Jean-Marc. I've got a few questions. Quickly, so one to all the panel. You're mentioning about currency and things like that. So with the recent developments in Senegal, where the suggestion is because of it was a large part of the electoral campaign that they'll move away from the CFA franc, what impact do you think that will have on credit ratings in the region or Senegal's ratings and what have you? And to specifically, a few questions. You mentioned about the role could ACRA play in helping that portal be taken on board and helping that data flow?
IT and mute, yes. Yes, Gregory, go ahead. I think you're muted.
Yeah, I'm sorry. I've just, for some reason, the flow of information didn't get to me. So you just have to, I haven't heard anything for the last few minutes. You just have to count me out of these questions, I'm afraid.
Okay, so let us move to our colleagues here. Bilal?
No, kindly repeat the question for Gregory. Otherwise, we can ask our colleague to just repeat his question. Thank you.
Can you repeat the question?
Yeah. So the first question was that when we are talking about assessment of debt from the investor's perspective, is it the total debt to GDP that the investors are focused on, or it's the external debt to GDP? And the second question was the refinancing is a very popular word in the international financial world, and we have seen a lot of countries, they refinance their debt in a more structured manner, that is well before the debt is due. 2 years, 3 years, 4 years, well in advance, they get the debt restructured. So possibly, is there a requirement for engagement with the investors in a more structured manner so that the default can be avoided in well before time? And that can give comfort to the rating agency or the investor community.
I think I can cover the
Yeah.
GDP.
Go, did you get the question?
So from an investor perspective, you kind of use all the measures you like. And I think debt to GDP is one of the measures, but it's not the best. I think for me, the best indicators of debt stress or stress in Africa have typically been interest payments to revenue for the entire public debt stock, because domestic debt has been an important pressure too. And then some of the short-term refi risks. So often I'd be looking at external gross financing needs versus FX reserves, particular spikes in maturities. You know, for example, this year, Kenya had a 2 billion maturity coming in June, which put their debt under stress, but they were able to get to the market and refi that. So for me, it really depends on the situation. I think you need a menu of these. Debt to GDP doesn't cut it on its own, but interest to revenue, and then it's some, you know, whether you're looking at liquidity risks and solvency risks. Now, the IMF, you know, Edge made a good point about how everyone reads the IMF documents, and their DSAs are helpful, but not definitive. They tend to focus on external debt too much for the lower income countries and focus too much on gross financing needs for the MAC countries, the market access countries. And we've got this missing middle for most of the Africa frontier, where you need to do a bit of both. So I tended to do my own bespoke debt sustainability analysis for most countries, or at least the 20 in the Eurobond market. I think for the aid-dependent African countries, the LIC DSA does a reasonable job. But for those with market access as well, you've just got to be a bit more innovative. So the short answer is you've got to go way beyond debt to GDP. Yeah.
Thank you very much, Greg. Any reaction from? Okay. Christopher?
So, Daniel, I'll cover your points. So firstly, perhaps just send them in reverse. I mean, Senegal, it's really interesting when you look at the CFA group of countries, because you know, they are all pulling in slightly different directions. You've got Cote d'Ivoire and Senegal really powering ahead. Senegal with the windfall that they've just got through with the oil and the gas, from which they're sharing with Mauritania, which will become an increasingly important country on everybody's radar. And Cote d'Ivoire with just a bit of just showing what happens if you get some political stability and the amount of just raw economic growth. I mean, exports of agricultural products, etc. They are the sort of, you know, micro Brazil of Africa at the moment. So that's pulling in the right direction. At the same time, you have you you have all of the challenges that we're seeing in the Sahel and many of the same countries in the same CFA that are getting into real trouble, and nobody knows quite how to deal with this complicated issue. So one of two things I think are going to happen. Equally, the French involvement is seen as both a positive and a negative. So I can see politically why it's attractive to say we should be ditching this whole thing. At the same time, I hear just as many conversations about the idea of creating an ECOWAS currency of, including everybody. The reality is that, people have savings, and those savings, they want them to be safe. And so it has benefited the CFA countries that people have been willing to keep their cash in CFA and haven't been looking. If you're in, I have a business I've employed people in a number of countries. They should remain nameless in Africa. But the number of times I get people saying, Edge, can we be paid in dollars? I mean, it makes no sense. But it's because they're worried about the cash in their own currency. And so if that starts happening, then that means that you can't finance yourself in your domestic currency. So I can see why it's politically attractive to say, look, Britain. So we beat this political drum a lot, but I actually think the CFA is serving West Africa and Senegal and the Côte d'Ivoire actually very well. With regards to this idea between the portal and the ARC, so the FTB is interested. They do provide a lot of this data already, but it's just provided on a sort of once a year basis, where they produce an annual economic outlook, which comes out at the time of their annual meeting. This is about essentially taking this vehicle would mean that all of that just gets updated real time. You don't have to wait for the one report to come out once a year, which I think is important. But I think there's a big difference between data and the analysis. Okay, you need the data. The data's got to be accurate. It's got to be timely, and it's got to be provided. But then you do need the rating agency, the ARC, or any of the other CARE or any of the other rating agencies that are looking at these countries to take that data and provide their interpretation and their analysis and their assessment. All we're saying is, let's start with good. Let's start with the right information. And if we've got the right information, then people can perform the analysis. And making sure that that information there aren't holes, that they get updated, that it's regular, that it brings in other bits of data which are not currently in the system, like the natural capital data. There's a thing called the Millennium Challenge Corporation, MCC, that sits in America. MCC unlocks massive amounts of grants that can come from the American government. If you look through the African countries, they all get rated by the MCC, and you have a scorecard. And you have to get over 50% on the scorecard to be eligible to access the MCC. There are so many points in that data set where an African country just gets a 0. And if you get a 0, it's basically a fail. So it's like you're competing, you have to get to 50%, but you just, as you said, didn't participate in a third of the race. Well, obviously that's going to hold people back. So this is about making sure that people know. And then the politicians have choices. People elect politicians. Politicians sit in the government and they have choices. Obviously, I think of being a minister of finance like sailing a yacht. You want to sail that yacht at the most extreme angle possible, because then it's going to go the fastest. You just don't want it to capsize. So you are massively incentivized to increase your fiscal spending. Obviously, spending money is popular, but spending money is spending future generations' cash. And often that doesn't get explained to the voters. This money doesn't exist. This money is being taken from your children and spent today. And you may like it today, but they will have to pay it back. And with this data, you enable those ministers to look and say, well, if I make this choice, then actually my score here is going to go down, and it's going to start getting reflected in my ratings. And the newspapers pick up on it, the academics pick up on it, and someone starts a debate in the country to say, hang on a minute, do we want this crazy fiscal strategy? I mean, there will always be external shocks, and Africa's been hit with more of them recently than anyone who would like. And clearly, if you're vulnerable to an external shock, you're going to weather that worse. But some of these shocks are self-imposed, and helping people. I don't want to take away from the rights of politicians, and people get elected with a strategy to make those choices, but people should go in to make those choices to say, I can't just promise to, make everything perfect, double everybody's wages. It's the data will show you that that doesn't work. Over.
Thank you very much. I think we have a very rich conversation here. Let Madam ask a question, please.
Thank you. I just want to, Hannah Ryder from Development Reimagine CEO. I just want to kind of give a bit of a word of caution around some of the use of some of the typical tools in the IMF and World Bank toolbox. But whether it's for country risk, political risk, also credit rating, and these are some issues which are kind of slowly being brought to light. But even classifications of debt distress and so on come with some significant problems. And I'll explain it very simply, as simply as I can. One of the problems with the international financial system is that we don't apply macroeconomic principles to it. We look at it as if it's kind of macro and isn't influencing behavior and perceptions, but it is. And I think, this consistent discussion of perception risk is helping us understand that. But as an example, debt sustainability frameworks, and including the kind of Article 4 negotiations and so on, the overall surveillance from the IMF and World Bank is in effect, it's weighted against poorer countries, just by definition. Think of it like those of us who studied economics, think of it like think of it like the market for lemons, or in another way to think of it is second-hand cars. Just by knowing a car is a second-hand car, immediately its price and attractivity goes down, just by being labeled a second-hand car. Even if you give loads more information, tons more information about that car, its mileage, everything about it, but just because it's second-hand, it will have depreciated somehow. And that is the effect of the debt sustainability framework at the moment, because you have a different type of surveillance for countries at different income thresholds. So as soon as you are in that income threshold, or with a different type of surveillance, you automatically either are a second-hand car or not a second-hand car. And that in itself is a challenge in the international financial system, that whatever we do as governments, African governments do, others who are in that same category, will not be able to change perceptions of unless we change those sorts of systems. So I just want to give, that's just one example of the problems that we're dealing with. They are not just about the way that African governments run. They're also about how the international financial system has different tools, different surveillance mechanisms. And unfortunately, that also means that institutions that are linked and use that information also exacerbate those sorts of effects. We're talking about foreign direct investment, we're talking about public investment. And I think, the idea of crowding in private investment, for example, is something that multilateral development banks want to do. It is no surprise if you look at, because all of these things are linked, it's no surprise that if you look at foreign direct investment as a percentage of GDP, if you look at lending from the multilateral development banks as a percentage of African GDP, the line is coming down. It is not going up. And that is reinforced by all of these tools, surveillance, and types of, and again, that is where the opportunity for an African credit rating agency lies. It is also where the opportunity for African firms that are doing country risk, political risk also lies. So I just want to bring that to the table as a further additional point, that some of these things we have to grapple with at a slightly different level, but also the firms and organizations that are involved here also have an opportunity to really address and create much more equality in the system. Thank you.
Thank you, Madam, for your contribution. So I saw a hand there. Please, sir.
Thank you very much. Congratulations to the team. Fascinating presentations. I have a specific question for Greg and Edge. I think your presentation was really inspirational to an extent that I do not want to miss the opportunity to ask this question to you. Before I do so, some quick underpinnings of my question. The first one being that Africa is in dire straits economically for the majority of its population. I think that's common cause, that Africa is in economic dire straits. And then the second one is that Africa has vast mineral resources, and I think again that's common cause. And third one, which is also common cause, is that African riches are beneficial financially and commercially. And the fourth one is that while these resources are beneficial, the proportion to which they benefit the economy that is in dire straits is out of kilter. So the majority of the people are not benefiting from the riches of their own continent. And fourthly, that the investors that invest in Africa do not invest only in bonds, that their investment is diverse, and therefore that they also invest in resources. The same investors, no investor just invests in issued bonds. So my question is, and I've seen that from your presentation, you're a very honest gentleman. My question is, do investors benefit more from an Africa with poor credit ratings, or is it more beneficial for investors, given the diversity of their investments and the underpinnings of my argument, to actually engage and deal with an Africa that has low credit ratings and in fact that is in default? What we do know is that from evidence, economic evidence, is that Africa does not benefit from poor credit ratings. So I just wanted to find out from you, Edge and Greg, what your take on that is. And it's a desperate attempt to answer a centuries-old argument, which might be pertinent in terms of changing the path for economic growth on the continent. And my question, I'll be very quick, Chair, for Bilal is country risk. Is it country risk, or is it continent risk, or is it Africa risk? Because it appears that whenever people talk about country risk, at the moment you mention that a country is in Africa, immediately there are certain spontaneous unsavory associations such that some of the general stereotypical problems with Africa are mapped onto whatever country is under consideration. So I really want to know if there's a distinct distinction between country risk, if we in fact do have countries in Africa, or if we just have appendices that are attached to one country that is Africa with one specific risk. And finally, to Mr. Mohamedi, there is no situation where we see an investor rating. Investors are not rated, the issuers are rated, and it appears as if there's this assumption of moral rectitude amongst investors that they are morally infallible. Is that the case?
Thank you, sir, for your questions. So let our panelists react before we take another one.
So if I pick correctly, the question is, one of the other factors the investor take into account is the moral aspect. Have I read it correctly?
So my question is that in your presentation, you argued that investor expectations are very straightforward. They're looking for return on investment directly from the investment that they have invested in and long-term sustenance of that investment. That is your argument. But I am asking you as a representative from Tanzania, knowing the context of the African continent, whether you believe that, because investors are not rated, whether you believe that they are morally infallible, that their intentions are upright, as far as their intentions are concerned in Africa.
Thank you for that question. I think in my own opinion, I'll be very objective in addressing that question because it depends from investor to investor. And when you look at the standard, most of the investors are still looking at three things. Essentially, this is not charity. Someone investing money, he wants return, he wants protection, and he wants his money back at some point. Now, whether other investors are looking at moral perspective, in my view, I haven't come across, but we could have. Few experience have engaged is domestic investors. Whenever there are delays in their payments, and next round the government continue to issue bonds, they still oversubscribe it. But I don't think by them buying bonds while the previous one are still in arrear, it doesn't mean that they don't have concerns. They still have concerns at the end of the day. So in my view, it's purely business. You put money, you are looking for return and protection, and at the end of the day, you want it to be paid back. I know investors are not rated, but borrowers who are in need of these funds, they are the ones who need to convince investors to put in their money and give them assurance that they will be able to pay. So I don't know if I've answered that question, but that's how I can personally address that. Thank you.
Thank you very much. To Bilal, is there any country risk when, as far as Africa is concerned, or there is a systemic Africa risk? What's your answer?
I completely get why that conception or that idea exists, and I think it's rightfully placed, and it's a reasonable question, especially when addressing country risk and the output that usually looks at Africa. It does jumble up North Africa together and the sub-Saharan of Africa as one region, and this region is particularly infested with terrorism and cross-border criminality, and in the southern region of sub-Saharan Africa, invested with coups, coup d'etats, and corruption is rampant. And usually that is the notion that is taken. However, this is changing. One, because investors themselves are beginning to understand the nuances, looking at countries, and there is a desperate attempt to get a grapple over the local risk perils, risk dynamics in particular jurisdictions. Not just that, people are becoming more and more interested within different dimensions of a jurisdiction. For instance, localities, municipalities, industries. So we are seeing noticing a shift, particularly from the investor side. If you're talking about trade finance, it's not going to be a useful tool for them to look to jumble up Africa as one, and then country risk becomes paramount. And the work we do, for instance, we rely heavily on researchers and analysts from from each of the countries and around Africa to provide that nuanced and qualitative views coming out from these countries, and not rely just on high level and generic assessments of some of these jurisdictions, which won't be useful for the clients and for investors.
Thank you, Bilal. Gregory,
I'll just answer the
do
point on.
investors benefit from in Africa with low credit rating? Your
Yeah,
opinion.
I think some do, and I think I have, in the sense that I think if you're, my sort of career has been, I've lived in many African countries. I've traveled to over 30, including all of the countries in the markets. I've spent time in Kumasi trying to monitor the real economy to feel Ghana's growth. We've spent time going to second cities, rural areas, traveling, analyzing weather patterns, the impact on hydro, going the extra mile to talk to people to understand and deepen our knowledge. So when I was a fund manager, we beat the market. We performed well, and we had better than average returns because we looked for those mismatches. If the credit rating was low and we thought the risks are overstated, we tend to do well. It didn't always work out. In a lot of those situations, there are problems, but I think there's been massive scope over the last 10, 15 years to do your own homework and invest on the basis of your own detailed analysis, ignoring the credit ratings, while most people are just putting things in baskets. So absolutely. So the energetic, active investor has definitely benefited from that status quo. But on the whole, but it's probably been not enough people that have done that homework to actually bid the prices of the bonds down. And that's the problem. So while a handful of people have done the homework and have a proper understanding of the real risks, most haven't. And that's why we're stuck. And there's not enough people in the markets properly questioning the credit rating and bringing that price and cost of borrowing down. Because ultimately, it's what investors pay for the bonds at issuance in the secondary that dictates borrowing costs, not the credit rating. Morocco is a brilliant example of a credit that doesn't really have an IG rating, but it always trades with an IG rating. It's just below that mark, but it has yields and spreads like an IG, because most people in the markets think the risk of default is overstated by the rating agency. So it's fascinating, but I think and that's going back to my earlier point, is if you can sort of bring more people in and hand feed them so that they get a better understanding of the true risks, then the market price will hopefully bid those borrowing costs down. So there's certainly some people who benefit, but it's only a handful.
Yeah, thank you very much, Gregory. I saw a hand up, maybe the two last questions. So you want?
Just 1 second, just to say, I mean, the second Gregory's point, I think it's definitely not the case that investors, are in some sort of collusion with the rating agencies to say, keep these ratings down, because that's not good for us. As Greg said, there are investors who do this work and identify that this country looks misrated. Then once they've bought those bonds, they desperately want those ratings to go up. They want the rest of the world to figure out that things are not as bad as they are, because then they start, that's what's gonna cause the bond to appreciate. So it's not the case that investors are sitting there saying, we love the fact that these yields are very high. And in fact, they do worry. I've spoken to a number of investors who've come into the recent Kenya bond, and they're sitting with this thing with a yield of over 10%, thinking, this is great because we could have been in a worse situation if Kenya had defaulted in June. But a 10% yield makes no sense for the long-term economic growth of Kenya. And so we need those yields to come down. We need the ratings to improve. and positivity to come back into the market. And I think one thing that hasn't been said today, but I saw yesterday, was that S&P has finally agreed, as a result of Zambia's actions, that they're looking to now reassign a rating, a positive credit rating to Zambia. And I really hope that that comes out in at a fair and ideally a single B level that would unlock a lot more capital to come back into the market. But I think Zambia hasn't got enough credit for the fact that while we've been sitting here, things are moving on the credit here as well. But
Thank you very much, Christopher. So we'll take the last two questions, Mr. here and Mr. there. And then we'll give a chance to our panelists to respond and give their final word. Please go ahead.
Great. Thank you so much. My name is Tim Berkeley from Interclear. You talked a lot about the mismatch of price, risk, and rating. I just wanted to hear your recommendations on how to better engage with institutional investors that have sort of mainstream processes for managing risk. They need to work with a mainstream rating agency, for example. I wanted to know how to better engage with those types of people so that they can better understand the opportunity to invest in these types of bonds. Thank you.
Well, Jean-Marc, listening to the conversation the whole morning, I have to ask, are there investors in Africa? Or is it that investors are only in Europe or North America interested in investing in Eurobonds? And perhaps what proportion in our countries, for example, when you think about sovereign, what proportion of our budgets are financed in that way? And therefore, are we really setting up a mechanism focused on a rather small portion? When, say, Kenyan banks or Tanzanian banks are investing in DRC, is that investment? And where does that feature in this whole conversation? Thank you.
Thank you very much for your excellent question. So let our panelists react and at the same time give their final word. So let us start with Gregory, who's online, and then we come into the room. Thank you.
Nothing further from me. Just thank you for the invite and best of luck with this really important endeavour.
Hi, Gregory. Are you done?
Yeah, I'm done. Just say thank you.
Thank you very much. And then Bilal.
When a financial institution invests in other country, is it considered as an investment, or where is it featuring in this discussion? I think it is an investment, but the theme of this discussion here was centered around the credit rating. But normally those investments are done on bilateral basis. You get the information, you do assessment in terms of the serviceability, in terms of the sustainability of the debt, cash flows, and then you make decision on bilateral basis. But here we are talking about a borrower is looking for a rating which investors can rely on. That's how I would express that. Thank you.
If I can also add, Africa is, and we've seen this again from many different countries, Africa has seen exuberant amounts of investments coming from Europe, US, China, Russia, and more recently, the Gulf countries. The UAE, the United Arab Emirates, is now the fourth largest investor in Africa after the US and China, and I think the EU. So, again, the investment climate in Africa is extremely active, and it's very robust, and in different sectors, seeing in the energy sectors, in the food security segment, in a lot of industries. However, if you are talking about trade financing, you are absolutely correct. I think, and I just came back from a conference in Cape Town that would focused on trade financing, and the conversation seems to be limited around bonds and Eurobonds and similar trade financing arrangements. Of course, then the conversation, I think the major worry comes around investing in other sources of financing is around guarantees and securities from governments on the continent, which has not been forthcoming. Hence, there's been a bit of reluctance, particularly over the past few years, specifically at a time where we're having foreign exchange and currency convertibility issues over the continent. It has caused a lot of investors to backtrack on some of those investments.
So Tim, to your question, I mean, the reality is there's a lot of countries that are trying to issue debt, but this is no different to any of our businesses. It's competitive out there, and you just have to use the shoe leather or the Zoom calls or the Teams calls to just go knock on doors and keep yourself present. Fortunately, these investors do tend to huddle in different locations. So for Africa, London and Johannesburg are two major centers of those investors. So you can be quite efficient in getting to them. But in my view, there is no shortcut to just getting in front of people and telling your story. It's also an amazing way. If you're a finance minister and you have to stand up and explain to an investor why you're doing X, Y, and Z, trust me, you pretty quickly start asking yourself, do I want to make that decision in my budget? Because how is that going to look when I go back to this investor and try and explain it to them? So that is happening. I think this point about are there investors in Africa, this is a slightly different area, but I do think it's worth flagging because we're in the issue of sort of sharing everything that, you know, the free trade agreement for Africa should, if it does what it says, mean a lot more free trade. And yet we have systems which look at your exports and to your reserves, or your imports to your reserves. And so I do think we need to create a way for Africa to either have central banks being able to hold assets of other countries that they're trading with as a mitigant. It cannot be that all of those reserves have to be funded with basically US treasuries. Because if you unpack the amount of Eurobond funding that is actually being used to support central bank reserves, is actually quite a large number. And so that number is only going to get bigger as the volume of trade goes up, which we want to go up. And therefore, we do need to think about either in the credit rating assessment or in different mechanisms. How do we stop that ratio just getting worse and worse and worse? Bye-bye.
So as we conclude this session, let me thank our panelists for their insight on this important theme, rebalancing investors' misconception on Africa. I think a lot have been said, and there is more to be said on that topic. I salute the last participant who came with a question, which is a food for thought. Are there investors in Africa? Are those investors demanders of credit rating? I think for further discussion, we need also to think of the credit rating activity or business in Africa. Will the African Sovereign Credit Rating Agency focus only on the sovereign, or will also assess the credit worthiness of the private sector? Africa has a huge informal sector. How we go about assessing its credit worthiness? We have rich people in Africa who are eager to invest, but they need to properly assess the credit worthiness of the informal sector that provide jobs to the majority of Africans. So I think there is a lot of to do, a lot of thinking to shape the credit rating business in the African continent. I really thank you very much for your attention and your candid participation. Thank you, Greg, for joining remotely from Washington. Thank you, Bilal, Christopher, and Saleh for your very valuable contribution. So now we'll have a break, I think a 15-minute break, and then we'll proceed with the last session, session 7, on the next steps for the Africa Credit Rating Agency before we hold our closing ceremony. Thank you very much.
Yes, welcome back. And it's now good afternoon to all of you. So as we move towards the end of our program for this retreat, I'll be making a very brief presentation on the proposed next steps of towards the establishment of the institution that we have been discussing over the past 2 days. I must also testify and appreciate the quality of conversations that we have all witnessed here, which will help us as the technical persons behind this project to make sure that as we proceed, we are taking the right steps towards achieving this a dream that I think has gathered so much momentum and is interest from and support from so many stakeholders. So I'll also use this opportunity, since I'm taking the floor for the first time in the retreat, to respond to some of the questions that were raised during the discussions from the participants directed to the APRM and ECA to share a bit of information with participants. So here in summary, these are some of the recommendations that we have documented, although there are many, but in summary, we think that these are the key takeaways that we have drawn from the conversations that we have been following. And number one, for sure, that we have consensus that the basis for the establishment of this institution is not to be a form of some political reaction to any political sentiments or any political ideas, but it's rather the legitimacy of wanting to have an alternative voice that, or alternative opinion that we have a more comprehensive understanding of the domestic perspective, especially on the sovereign rating space. And number two, that the institution is being established not as a hostile player to compete or wanting to replace the big three. And those institutions, we all agree, they've been around for a while. And they have a certain space that they have occupied. And they serve a particular purpose. But the niche that the proposed institution will occupy, there is a huge opportunity in terms of unrated countries and also in terms of the sub-sovereign and corporate space. So the underlying factor is that there is enough business for all the rating agencies to operate. And number three, that there should be some formula for this proposal to fit into and to leverage into the work that multilateral development institutions undertake, which was explicitly supported by some of our colleagues that were in the panels, that there are several rating agencies that they are using, smaller and unknown from other continents, that they can easily replace if this institution is moved to be established. And number four is that there is need to establish a strong relationship with private sector. I think this goes without saying, since the decision is very clear that this institution must be private sector owned and must be private sector driven with a profit and efficiency incentives. The comprehensiveness of methodologies, which has been a topic of discussion for a long time, because of the conspicuous omissions that the methodologies of the big three have been applying for a long time. And lastly, that the decision on the country of locating this institution will be based on several factors, but amongst those is to be able to draw confidence because of the robustness of the regulatory frameworks that this agency will be subjected to. And once it has gone through those regulatory processes, there should be some confidence from whoever is receiving information as, from the produced by this institution. We have some confidence that it has been thoroughly examined. So I thought it's important for me to mention this just for giving some confidence and also context to some of our colleagues who might be participating in this platform for the first time. That this conversation started several years back, and as part of our rigorous process of arriving at the conversations we are having now, we were tasked to undertake 2 studies that we contracted independent firms to undertake. The first one was completed in 2020, and that study was specifically focused on examining whether the process or the idea of establishing an African credit rating agency, that time it was specific that if this rating agency is established by the African Union, is it feasible to do that? So we contracted an independent firm to undertake that study. And it was a very comprehensive process which involved consultations with various stakeholders, including civil society, banks from various countries, and also the multilateral development banks, the stock exchanges, and it was quite a wide spectrum of consultation that was undertaken. We are very sure of this because we're involved in the process to support the consulting firm that undertook the study. And the conclusion from that study was that it was feasible to undertake that process of establishing the institution. And from that, there were several recommendations either to establish it as part of the African Union or whether to take over an existing rating agency which already have an established methodologies and processes of operating in the business, or either to undertake it as a joint venture with an existing rating agency. And those options were presented to ministers of finance, who then tasked us to further undertake another study on the appropriate legal, financial, and structural nature of this institution. And that study was also undertaken with consultation from other existing rating agencies for us to come up with a practical recommendation of the legal nature, the structural nature, as well as the financial model that could be feasible. So this was the outcome of that process, which led us to the decision that has been discussed over the past 2 days, that this institution should be an independent owned, independent shareholding, and also it must be self-financed because of the issues that all of us are well aware here of, that it needs some credibility, and also the legitimacy of its independence must not be questioned. So the legal model is obviously independent and private owned entity and independent shareholding, as well as the governance structure. So the process of incorporation, registration, license, and all the necessary steps will be done in terms of the relevant laws, so that there is no resemblance of some privileges that this institution will enjoy that will bring the credibility into question. And in terms of the ownership model, this is what was recommended, that there should be some ownership from Pan-African multilateral financial institutions, because several questions were raised. I think you may be aware that Moody's acquired West Africa Rating Agency some time before, and 2 years back, it also acquired GCR, which we were working with quite closely in terms of supporting them to expand their portfolio of ratings as part of our mechanisms of support. And to that, it was to us, it was quite a setback. And the questions were raised in the AU platforms that if this institution is independently owned, what will stop the big three from going to acquire it? So that's part of the ideas that led us to recommend that there should be some Pan-African institutions that does not prioritize money in front of the idea and the mandate that this institution will have. So that was the recommendation. And then also that we should consider very strongly the wealth of experience that comes from the domestic or the African-based rating agencies. That's why you see that we invited them here to also share their perspectives and to show their interest in supporting the project. And also from international investors, they will not be shut out, because they also bring some competence and confidence, because this information is also needed for consumption within the international financial market space. Then on the structural model, this was a basic structure for a rating agency to be able to operate. So this was adopted out of that process of consultation, which we also recommended in our submission to ministers. I think I've spoken about this, the financial model, that it will be funded through its shareholders' equity and through the revenue that it will generate from its service. So in other words, we were explicit and we are still explicit on this point that there will be no any contribution from any government to address the concerns around the issues of independence and a conflict of interest. Right, this is just for your information to show that there is some thorough work that went into this process. There are financial projections that were that were proposed, and there were a lot of assumptions, very practical assumptions that went into the process to arrive at these conclusions. So in concluding this presentation, we've got a draft roadmap that we have worked on, that we envisage that this is the process that we'll go through in implementing this decision and operationalizing this institution. So the first one being consultations with relevant institutions that we think will be key to the practical steps of establishing the agency. And this platform also is part of that consultation. And we will take all the ideas that have emerged from this engagement as we go to the next steps of initiating memorandum of understandings with other Pan-African institutions as also part of our process of mobilizing resources for this particular purpose. And another concrete step is we will be engaging a transaction advisor that will facilitate the process. As you could have seen, that it's not an easy process. It's a complex process, and there are so many blind spots that we might encounter in the process. So a transaction advisor will be critical to guide through the process. And also, as we are doing that, we are parallelly trying to raise the necessary financing, because that should be inevitable. And next, we envisage that at the end of that process, we should be able to have concrete shareholders, if I may use that word, or must be able to have identified shareholders that should be willing to hold stake in this institution and willing to also commit on paper and also facilitate, because it will be their decision on where they would prefer this institution to be hosted. So after that, we envisage that then the proceeding processes will be initiated, the general meeting of the agency, and also the process of obtaining the necessary licensing, building up to the launch of the institution. So holding other things constant, we presume that this process, since there is not much that is still within the need to be approved by the AU structures, we should be able to complete this process by end of this year. So I put this to your submission and to your input, as you have also been inputting into the discussions that we have been having. If there's any suggestions, they will be more than welcome. I see my chief wants to say a few things. Yes, Chief.
No, thank you very much, my dear good brother, Dr. Mission, since I'm taking the floor for the first time since we arrived at this beautiful and historic city of Lusaka. Let me take this opportunity to thank the government of Zambia and the people of Zambia, most importantly, the national structures here, the National Secretariat of the APRM and the National Governing Council for the warm hospitality extended to all of us, and also thank the participants for their time and effort and contributions to this noble initiative. So I'm looking at the roadmap, and I see that we, on the 31st of May, we want to appoint a transactional advisor for the process of operationalizing the Africa Credit Rating Agency. So I would, on the basis of on the basis on how we should sequence the activities. You recall that the STC has already recommended to the Executive Council to operationalize the establishment of the Africa Credit Rating Agency as private sector driven and sustainable as self-financing. So, but that is a recommendation legally. So the recommendation has to be adopted by the Executive Council in July this year. So I would propose that we immediately after that recommendation has been adopted and accepted by the Executive Council in July, it will then thereafter that we would appoint the transactional advisor, then the other steps would naturally follow. But without that decision of the Executive Council, which is a policy organ of our union, that number, the third step would not take place because we will not have the legal authority to even conceive that at that particular juncture. It's my humble submission. Thank you.
Thank you very much, Chief. I think that's well noted. We'll import it in part of as part of our roadmap. Thank you. So I still want to invite if there is any. Yes, I see my brother Justice.
Yeah, thank you very much. I think I have two comments. So the first one is on regulation. I saw in the schedule of activities, there is compliance with the regulations. So the question would be, at what point are regulations going to be developed to support the agency? Or are you going to consult with specific regulators? So then if they agree, then you can go ahead with the same. The number two is on shareholding. Perhaps we may have to cap shareholding for those outside the continent, just to ensure that the interests of that continent are taken care of. Otherwise, you could have someone having more than 51% shareholding and they can call the shots just by the fact that they have a higher shareholding than those from within the continent. I don't know what that would mean. Thank you.
No, thank you. If I may respond to that, I guess I got you clearly on the question of regulation. So on that specific point, my humble response will be, as the APRM, we are there to facilitate the process of establishment, but we will not be owners of that institution. And since we will not be owners of that institution, it is my thinking that number one, the location of that institution will be a decision of its shareholders. And number two, that Also, the process of undertaking that institution through regulatory processes will also require the question of who is going to be the owners to be explicitly established, because it needs the structure to be completed also before that process is undertaken. So I think that will depend on where the institution will be, because there are some countries who don't also need some regulatory frameworks to be completed before an institution of that nature is established. So that's my quick response, that it all depends on who will be the shareholders of the institution and where would they want this institution to be based. A decision which we as the APRM and our strategic partners will not be able to make determinations on. And on the second question, I think you asked about, can you rephrase the question so that I can respond to it with a satisfactory answer?
Yeah, so I was saying, if you check out the shareholding of Accra, you have indicated that it will both be African and non-African. So what I was saying is, we may have to be sensitive to their shareholding that will be from outside Africa to ensure that a person from outside Africa does not become the one calling the shots within Accra.
No, thank you. I think that's more of a cautionary contribution. So it's very much welcome. I think I've noted that the question was also raised during the engagements of the policy organs, that what brings a assurance that this institution will carry the mandate that we are establishing it for. So for that to happen, I think it needs to, or who owns the institution will be key, and what will be their interest in the ownership will also be of a particular importance. So with the variables within our controls, I think that should be some of the cautionary factors that will be taking into consideration as we facilitate the process, so that it is not taken over by shareholders who are not willing to advance the Pan-African sentiment that is behind the establishment of this institution. So I hope that answers your question. Yes, Professor Kesh, and yes.
Thank you, Mishek. So I think the first point on shareholding, you mentioned it on the slides. You can protect against that with the different classes of share. So I think that's easily sorted out in terms of attaching votes to the A shares, but nothing else. Just two very small points. You mentioned a credit rating agency could be a shareholder as long as it's not affiliated with any of the big three. There will likely need to be a process whereby if they are a shareholder and then taken over or affiliate, that they get removed from the shareholding, because the suggestion is that the big three are going to look more at the African continent and domestic rating agencies to take them over. And I think essentially the final point is in terms of, you mentioned, if I look at the timeline, you mentioned to get the regulatory compliance sorted, the timeline will be 30th of November, and today we are, what, 28th of March. Every time I've seen a credit rating agency go through that process, it often takes longer than the advertised times in terms of the regulator getting back to you with documents. There's a lot of back and forward. So the sooner that can start, the better. But that was it.
Let me respond to the two questions, then you can come in. Thanks, Daniel, for raising that. It's also, that question was also raised in our consultations, that why are we, in fact, in the beginning, we were recommending that the African-based rating agencies may not be part of it. But to them, they've certain constraints to grow their portfolio, especially in the sovereign rating space. And for them, it's an opportunity that they can also use to explore that space. So we saw that there is no damage in them being part of the process. And your question, I think it's specifically that, what if this African-based rating agency is acquired in future? So it depends. That's my response. It depends on the structure of ownership and how much they own in the rating agency, in the Africa rating agency. So it could be some of or part of the recommendations that we should have in hindsight, that if that dynamic happens, they will not end up being a majority shareholder, and also leading us into the scenario that we are trying to run away from. So it's a very important input. It's a possibility that could happen in the near future. My colleagues who are in the African-based rating agencies, they will testify that the big three are not stopping. They continue to knock on your door and offering you, very irresistible offers. So it's a very, very realistic possibility that we need to guard against. Yes, so.
Thank you, sir. Mine is a simple one. I think this was raised by Ambassador Mchanga yesterday when he made these observations on the three issues that he raised. One of them was the issue of the ambiguity in the acronyms or the abbreviations of Accra and Accra City in Ghana. And my simple suggestion or proposal is that, and this is to help those who carry the work forward so that they do not belabor the issue. They must have an option. My proposal would be, why or how would it be if we just added a small letter F or a lowercase f after the first A, so that it is Accra, so that we distinguish it from Accra in Ghana, but also that it is very clear that whoever reads and it is just abbreviated, it speaks to the credit rating agency. I thank you.
Your leadership, that man. I think it's something uncontestable that should be considered. Of course, I think Accra in Ghana has double C. Yes, but for lack of doubt, I think it's important to consider that. So as part of the recommendations in our future documents, I think we'll consider that so that there is clarity on the acronyms. So thank you. So any other input? So I guess we have exhausted this agenda item. And maybe before I forget, Daniel, I think I forgot to respond to the issue of regulation. So that, I think you're very right, that we need to start paying attention to the possibilities of the processes of regulations. So it's something that we took dig deep into as we were undertaking the studies. So we have got all the list of requirements on the possibilities of countries that could be best suited for that institution to be located. So it's something that I think we should be able to have some leverage on, but not underestimating the caution that they've just given to us. But thank you for raising that input. So colleagues, let me pause here and invite my colleague who will be presiding over the closing ceremony. But from me, I really appreciate your input, and I hope that in the next engagements that we have, would have moved to the next steps towards implementing this idea. Thank you very much.
Afternoon. We have reached the end of this insightful retreat. And I would like to invite Dr. McBride in Kalamba, who will be presenting closing statement on behalf of Prof. Eddie Maloka, the CEO of APRM. Take the floor. Thank you.
Good afternoon, and thank you, AG. First, as my colleague has indicated, I'm making a statement on behalf of our CEO, Professor Eddie Maloka, who you interacted with. I'm sure you're now aware that he has been instrumental in both getting this idea within the African Union and, of course, popularizing the whole question that we have been discussing here among the different stakeholders, but as well as providing leadership at the Secretariat to get this agenda. He should have been here to close, but he has other engagements here in Zambia related to our work, which involves senior government officials in this country. So that said, I think we both firstly have to acknowledge that this has been a very dynamic meeting. We recognize the various contributions. Firstly, the contributions that came towards defining the challenge that is before us. I think at each and every meeting, we have a much clearer view of what we consider to be the challenge that we are addressing beyond what was initially purported, but also the efforts to create the context required for this credit rating agency to be established. There was a lot of contributions there, key of which was that we need to engage the private sector and that we need to have a context in which we can develop a capital market before we can talk about the success of such a rating agency. But the contributions, a lot of contributions also went towards the niche of such an agency. And of course, the critical law and elements of an effective regulatory environment that is required in order to ensure the success of such an agency. There were also contributions, which we appreciate as a secretariat, that went towards the improvement of our report, which is a biannual report we produce on rating reviews, which initially started off as a response to the rating opinions, but we have now been encouraged to produce a much more comprehensive report. And of course, there are a lot of contributions that went towards understanding investors and their relationships to credit rating agencies. We appreciate all that. The participation, obviously, very, very clearly, there was a lot of interest and energy, a lot of expertise and novel insights were shared here, a lot of expertise was demonstrated here, but also the diversity of opinions, which demonstrates the diversity of the participants here, both in terms of nationality and the disciplines, experience that was laid to bear for this process. I personally saw that there was absolutely constructive contestation and criticism. Where we differed, it was clearly productive. And last but not least, and very important, is the optimism and the positivity. I did not see any sentiments discouraging us from pursuing what we set out to do. Our goal for for this process, specifically the establishment of the credit rating agency and the entire initiative within the Secretariat, is basically to increasingly establish Africa as a partner on the global stage. These efforts are not meant to negate a particular sector of the global community or a particular sector of the industry, but we are seeking to establish Africa as a partner. And I think those of us who've been in this industry understand what we're talking about. But also, we seek to direct our efforts towards convergence, convergence in values, convergence in policy and approaches. We are not seeking to create a divergent approach, divergent values, but we share the values that are established, and any efforts we're undertaking is really pretty much in that direction. Both within Africa, convergence within Africa, and convergence with our international partners. Ultimately, we want to create, as I've said, a viable Africa capital market, which has benefits for the entire globe. A prosperous Africa is not only beneficial to Africa, it's beneficial to the entire globe. And ultimately, we believe that we'll be able to shift the narrative on Africa's creditworthiness. Finally, I would like to register our gratitude first to the distinguished panelists who brought a great deal of knowledge and a great deal of insights to the processes that we are seized with here. Our partners that are here, the delegates from the floor, participants who are not panelists, but who contributed a great deal through the questions and the comments that we got here. The technicians who made it possible for us to have our colleagues join us virtually, and for us to communicate here in different languages, our interpreters, the logistics team, the rapporteurs, and in particular, special gratitude to Dr. Mutize, who leads this initiative, who's led this initiative as the technical lead for the past 4 to 5 years with the support of AG. But equally important, the members of the ad hoc committee, which has acted as an expert reference group for all the work that we have undertaken in this regard. Finally, I would like to encourage you to accept our invitation to join the community of practice that we are establishing. Dr. Mutize and Ms. Eji will share the details. I would like to establish all those who have participated here as part of the community, that community of practice, as we further the conversations beyond these formal settings. And I would like you to continue, encourage you to continue to engage with us in the same disciplined, expert manner that you have. With those few remarks, I would like to wish us all a safe trip back to our respective destinations, and look forward to seeing you and engaging with you in our subsequent events. Thank you.
Thank you, Dr. Nkalamba, for those concluding and closing remarks. I now invite Ms. Sonia Isimbojo, who will be delivering a closing remark on behalf of Dr. Hannah Mursi, the Deputy Executive Secretary of UNECA. Madam Sonia.
Thank you, Madam Moderator. Good afternoon, distinguished delegates. So as we conclude this retreat dedicated to the establishment of the Africa Credit Rating Agency, I would like to extend my deepest gratitude to all participants for their invaluable contributions. Your insights and expertise have not only enriched our discussions, but have laid a solid foundation for the establishment of a credit rating agency that truly reflect the unique economic landscapes of our continent. We are at the dawn of a new era in Africa financial markets, an era where we take charge of our own narrative, assess our creditworthiness, and pave the way for sustainable development through informed, fair, and localized financial assessments. The journey ahead is not without its challenges, but the commitment and collaboration demonstrated over the past days assure me that we are all well equipped to overcome them. Some key takeaways from the retreat. the importance of building the capacity of regulators and market participants in credit rating, the need to improve and harmonize the regulatory frameworks for credit rating agencies, the need to foster collaboration with existing credit rating agencies, and finally, the imperative of working to develop our domestic capital markets. Let us carry forward the momentum generated here and continue to work tirelessly towards operationalizing an agency that will serve as a cornerstone for financial integrity and empowerment across Africa. I would like to express my gratitude to the Zambia government for welcoming us to Lusaka. I would like to thank the staff of ECA and APRM for the support provided to the organization, and of course, the colleagues who provided IT support and interpretation. I will also join my voice to Dr. McBride to thank Dr. Mishek, AG, and colleagues for the leadership and hard work to, around this initiative. Finally, I thank you once again for your dedication as we look to the future we are shaping together for our continent. Thank you.
Thank you, Sonia. And APRM is very grateful to have all-season partners such as you and ECA who have worked this journey with us for so long. We are very grateful for the support and collaboration we've been having with you and ECA. Last but not least, let me now invite Ms. Lois Mulube, the Acting Permanent Secretary for Planning and Administration, representing the Minister of Finance and National Planning, Zambia. Madam.
A very good afternoon to you all. I would like to recognize Professor Afeikana Theo Jerome, the Special Advisor to the Commissioner for Agriculture at the African Union Commission. Dr. Nkalamba, I guess you're representing the outgoing CEO of the APRM Continental Secretariat, senior government officials from the African Union member states, distinguished ladies and gentlemen. As we come to a conclusion of this retreat, I want to express my gratitude to you all for your valuable contributions and insights. The discussions, presentations, debates, and collaborations that have taken place since yesterday have been truly insightful and thought-provoking. You may wish to agree with me that from the discussions you've had progress in laying the groundwork for the establishment of the Africa Credit Rating Agency. I think a lot of progress has been made on this. I am confident that with our collective efforts and commitment, we will be able to achieve our goal of enhancing Africa's financial stability and promoting economic growth. Distinguished ladies and gentlemen, as we have discussed, we acknowledge the need to consider African countries' peculiarities, data needs, regulation, continued collaboration, as well as the willingness and ability of all African countries to operationalize the Africa Credit Rating Agency. I wish to encourage you all to continue working together by sharing knowledge and expertise and remain dedicated to this important cause. Let us stay connected, support each other, and strive towards a brighter future for the African continent. I also wish to reiterate our government's gratitude to our fraternal friends, officials from the governments on the continent that have been part of this retreat, which has given impetus to the efforts to expedite the establishment and operationalization of the African Credit Rating Agency. Thank you once again for your participation and dedication. I look forward to seeing the positive impact that our collective efforts will have on the financial landscape of Africa. Safe travels to all that are traveling and best wishes. I thank you.
Thank you, Acting Permanent Secretary, for those words. Finally, I just wanted to indicate that this meeting wouldn't have happened if it was not for the collaboration that we have had with the Ministry of Finance here in Zambia, and we really appreciate the support that you have given us. In addition to that, the APRM has got an APRM national office in Zambia, hosted under the Ministry of Justice. So the National Governing Council members are present in this meeting. We wish to extend special gratitude to them, as well as the National Secretary at the head of the National APRM office. Thank you all. Have a fruitful afternoon. Enjoy the rest of your stay here in Lusaka.
Good afternoon.